Corporate Finance OneNote Practice Problem. In this presentation, we will work a practice problem in OneNote related to depreciation and the effect of depreciation on an accrual basis and a cash flow basis. Get ready to take a stance with Corporate Finance. Here we are in OneNote. If you would like to follow along, you're not required to do so, but if you have access to OneNote and would like to, we are in the 231 Depreciation and Cash Flow tab under the Practice Problems section. Closing this back up, we're going to have our information up top, and then we're going to put that information into the blue area working our problem on down below. Our focus will be in like a cash flow statement analysis. We're going to be looking at some of those things that will be differences from an accrual basis and a cash flow basis. So remember, when you think about the statement of cash flows, you're basically thinking, or when you think about financial statements, you're typically thinking balance sheet, income statement, but those two things have been constructed on an accrual basis. We also want to see a cash flow basis. So when we think about a cash flow basis, typically we are thinking about something that will be timing related, similar to an income statement. So we want to think about the differences between what would happen on a cash flow statement and an accrual basis. One of those differences has to do with depreciation. Depreciation is an example of something that will differ on a cash flow basis and an accrual basis. Now, what is depreciation? You'll recall that depreciation is something related to property, plant, and equipment, or fixed assets, or depreciable assets. Same thing, different words. So it could be called property, plant, and equipment, depreciable assets, or fixed assets. And those are things like cars, those are buildings, things that are going to have a long life when we buy them, even if for cash. On an accrual basis, we don't expense them at the point in time of purchase, but we put them on the books as an asset, and then we allocate the cost of them through depreciation expense over the time period in which they will benefit future time periods under an accrual basis. Now, under a cash basis, then the depreciation is going to be in a period for which no cash was actually expended, because the depreciation might be for a future period when the thing was purchased in the past, and therefore no cash is being affected when the depreciation is taking place. Let's think about this with a problem here. We've got company A gross profit is $890,000. Company A depreciation is $370,000, and company A's selling and admin is $125,000. And then B company, we're going to have a different scenario so we can compare them. The only difference being the depreciation, B having the same gross profit, depreciation's at $65,000, and the selling and admin at $125,000. Tax rate then is going to be our 40%. So let's take a look at an income statement. When we're considering the income statement, we're considering the normal accrual process. So we're going to have the gross profit up top. So we're going to start off with the gross profit that is going to be given. Remember, when we're thinking about gross profit, we're thinking about revenue or sales minus the cost of goods sold. So we're starting at basically the gross profit area, a little ways down on the income statement, revenue minus cost of goods sold, not yet down to the net income section, because that's where the selling and admin will be. Those are going to be the same for A and B. And then we have that difference here of the depreciation expense. Remember, the depreciation expense is something that will be an expense on normal accounting, representing the allocation of the cost of the fixed assets to the time period that will be affected. So we may have bought the equipment in the past, whether we paid cash for it or financed it, we put it on the books as an asset and now are allocating the expense. So the assumption here is that this expense is for equipment that was not necessarily purchased this year at all, whether cash or not cash was involved. It was purchased in the past. So this is an allocation of that cost to the period that we think is going to be affected. Then we've got the operating profit being the gross profit, the 890 in the case of A, minus the 125 minus the 370, giving us the 395, and B, the 890 minus the 125 minus the 65,000, the difference being the depreciation to give us the difference in operating profit. A having a much less operating profit due to a much higher depreciation, which means they must have more recent, fixed assets, more depreciable fixed assets on a book value basis that are now being allocated out there in terms of depreciation, increasing the depreciation, decreasing the operating profit. And then B, has less. So everything else is the same, but they got this depreciation now, but they have less fixed assets. They're allocating less cost. Therefore, they have a higher operating profit from an accounting standpoint. The difference is going to be that $305,000 due to the difference in the depreciation rates. Then we have the taxes that will be allocated in on that. Taxes were the 40%. So if we take, let's pull out the trusty calculator. We'll do a quick calculation on that. Trusty calculator, we're going to be taking the $395,000 times the 0.4. That's going to give us our 158, and of course the 700,000 times 0.4 is going to give us our 128. So then we're going to be subtracting these out to get to our earnings after taxes, or basically the net income amount. And that, if we pull the trusty calculator, is of course the 395,000 minus 158,000 to get to the 237,000. And the same for B, 700 minus the 280 to get to the 420. And then we have our difference in our net income being different by the 183,000 due to the depreciation. Let's do this on a cash flow basis. Let's say we weren't on an accrual basis, but we were on a cash basis. And you can imagine the transaction that's going to happen. We can do this, two different ways. Let's first take our net income as we would do on a statement of cash flow and basically back into what we would be in a cash flow basis. So we're going to back into basically what happens on a cash flow basis. So if we take the earnings after taxes for A and B that we left off with, we're going to say, hey, we need to add back the item that was non-cash related. That's going to be depreciation. So this depreciation then, the 370 and the 65, are now going to be added back if we were to think of this from a cash flow basis, because that depreciation represents an expense, a decrease in the net income, which was not representative of actual cash that went out. Therefore, if we were to use kind of like an indirect method, starting at the end result on the income statement, net income or earnings after taxes, and then adjust for those items that need to be adjusted to bring us to a cash basis, we would be adding back the depreciation. And that means that the 237 plus the 370 gives us the 605, and the 420 plus the 65,000 is the 485. So that's going to give us then a difference of the 122. Now, why is that 122 not simply the difference of the 305? Because the depreciation, although it isn't something that has a cash effect, does have a tax effect. So, right, it's going to be something that's going to affect our taxable income. So we're still having an effect on the taxes due to the depreciation, even though the depreciation itself is going to be backed out with regards to the cash flow statement. So this is kind of like the indirect method. That's what we're going to think of to do basically for the indirect method. We're going to start at the ending point of the net income we already calculated when we get to the statement of cash flows, and then back out those items, at least in the operating section, that are non-cash related or that need to be reversed to get to a cash basis method. So this is kind of like the indirect method. If you were to think about a more direct method, you might say, hey, it makes more sense to me if you just reconstruct the entire thing here, the income statement, as if you were on a cash basis. And you could think about that. You could say, okay, well, what would happen if you just did the income statement on a cash basis, in essence? That would be the same as the first part of the statement of cash flows, in essence, the operating sections, the cash flows from operations. So you could say, well, let's try that. Let's say we do the income statement and say we're going to do it on a cash basis instead of an accrual basis. We're going to start off the same with gross profit for A and B and the selling and admin the same, but then we simply wouldn't have the depreciation expense. It wouldn't be there because no cash went out. We're going to say that cash went out for the gross profit and the selling and admin. That's the assumption here. And so no cash went out for the depreciation. We're going to say that that's going to be the non-cash related item. So then we're going to have the operating profit then is going to be the 890 minus the 125. The 890 minus the 125 is the 765,000. And then we're going to have the taxes. Now the taxes we're still going to calculate based on the depreciation having been taken, meaning these taxes aren't simply going to be 40% of the operating profit, because taxes are typically something that will affect the calculation of taxes. So we're pulling these numbers from here where the taxes were being calculated on the operating profit. So we still have depreciation impacting the amount of taxes. Therefore, we have a difference in the tax calculation. It was not the same because it's not simply 40% of the operating profit, but taking depreciation into consideration. So we still have a difference in the earnings after taxes because, the earnings after taxes or net income, but that's because of the tax effect. And notice we pulled out the depreciation. So this would be kind of like the direct method. We get to the same bottom line number as the indirect method, the 607 and the 485, 607 and the 485. This second method is probably easier for most people to follow because you can basically explain it. You can say, hey, look, this is the income statement up here on like an accrual basis method where we have things like depreciation and we're going to have other types of things that are on an accrual basis for measurement purposes. And then we reconstructed it on a direct method down here, and we just made it on a cash flow basis, recording these same line items basically on a cash flow basis. That makes sense to most people. But what you don't have from this method, even though you get to the same bottom line number, is a reconciliation of the net income from an accrual basis to those things that are the adjustment to get to the cash flow basis. And that's what a lot of times regulatory people like to see, right? Or we like to see that kind of, I want to tie in one to the other. I want to be able to tie in exactly what the difference is. And for that reason, many types of regulatory burdens might still require an indirect method, something like this, to show that reconciliation process, even if they do a direct method like this, reconstructing the income statement. For that reason, most people will focus in on, and companies will focus in on the indirect method, doing this reconciliation type of process when thinking about the statement of cash flow. So that's what we would focus in on. That's what you have to get familiar with.